know that feeling when your money's just sitting there
Yeah.
in an account, maybe getting a tiny bit of interest, but not really working for you?
Yeah, I think a lot of people feel that.
And maybe you've thought about the stock market, maybe looked into it a little, but it just feels so complex, like a whole different language sometimes.
That hesitation is really common. It often seems like this risky, complicated place. Hard to know even where to start.
Well, that's exactly what we're diving into today. We got some great questions from viewers of the 144 Technologies YouTube channel, all about the basics, the fundamentals of stock market investing.
Yep.
Think of this as a straightforward, no jargon breakdown, what you really need to know. So if you're totally new or just want to firm up your understanding, this is for you.
Right. Our goal here is to, cut through that complexity, explore the core reasons why it can be such a powerful tool. We'll look at the different ways you can approach it and really get to grips with the key ideas for getting started without feeling overwhelmed.
And we're basing this on insights from two parts of a 144 Technologies video transcript.
Yeah.
So leaning on their expertise today.
Exactly.
Okay, let's unpack this, the big question. Why even think about putting money into stocks? The team at 144 Technologies makes some pretty strong points. First big one, building wealth.
Yeah, and what's really compelling is the trajectory. Looking back over the long term, stocks have, generally given higher returns than just cash or, say, bonds.
Right. Safer options, but maybe lower growth.
Precisely. Now, you absolutely have to remember short term, prices go up, prices go down. That happened.
Oh, yeah.
Volatility.
But those bumps tend to smooth out when you zoom out, look over many years.
They mention the S&P 500 historical average, right? Around 10% a year.
That's the figure they cite, yeah. And they give this really striking example to make it concrete.
The $10,000 one.
That's it. $10,000 in the S&P 500 50 years ago, potentially growing to over $380,000 today.
Wow.
But, and this is crucial, they immediately add the caveat. The market doesn't just go straight up. There are down years. Super important reminder. But still, that power of compounding over time. Yeah. It connects to protecting wealth too, doesn't it? Inflation.
Absolutely. That's the second key benefit they talk about, protecting what you have. Think about inflation. The Fed targets around, 2%?
Yeah, roughly.
So that slowly eats away at your money's buying power if it's just sitting in a savings account.
Yeah.
Even CDs. They might barely beat inflation, maybe.
Your money's locked up.
Exactly. Stocks, historically, have been a better long-term shield against that erosion.
Plus, and this got my attention, taxes. The way stock investments are treated.
Generally more favorable, right. Equity investments, things like dividends, capital gains when you sell for a profit, often taxed at lower rates than, say, your job income or bond interest.
So more of your returns actually stay your returns.
That's the idea, which leads nicely into another potential benefit, maximizing income.
Through dividends.
Exactly. The videos highlight dividends, those regular payments some companies send out to shareholders.
Like getting a slice of the profits.
Sort of, yeah. And they offer several pluses. They add to your total return, obviously. But they can also potentially make a stock a bit less volatile, provide some price support.
Interesting.
Plus its income. And it often suggests, that the company is stable, making consistent cash.
Okay, but not all stocks are the same in this regard, are they?
Yeah.
They talked about common shares versus preferred shares.
Good point. Very different beasts in some ways. Common shares, that's what most people think of when they hear stocks.
Right?
The benefits there, well, potential capital growth, the stock price going up over time, dividend income, like we just said, often tax-friendly, and interestingly, voting rights. You get a small say in company matters, probably not changing the world with your few shares, but collectively.
It matters.
It matters. And liquidity, easy to buy and sell, generally. Much easier than, say, real estate or art.
Yeah, definitely.
And again, that potentially better tax treatment.
Okay, so that's common stock. What about preferred?
Maybe a little. Their focus is different. More about providing a predictable income stream.
Oh, okay.
They usually have a fixed dividend. And it has to be paid before any dividends go to common shareholders.
So more reliable income.
Generally, yes. And often, the dividend rate is higher than on common shares from the same company. Plus, there's variety. Some preferred shares might accumulate unpaid dividends, or even let you convert them to common shares later.
Interesting options there. Okay, so building wealth, protecting it, getting income, different share types. It's painting a pretty good picture. But what about that barrier to entry? Needing tons of money.
Yeah, that's a huge myth the videos tackle head on. They really stress that investing is way more accessible now, financially accessible.
You don't need thousands to start.
Nope. They use that relatable example, investing what you'd spend on a daily coffee.
Right.
Things like fractional shares, buying just a piece of one expensive share, and zero commission trading at many brokers. That's blown the doors open. You can genuinely start small.
It really has changed the game. I remember when commissions alone could wipe out a small investment.
Totally.
So the source boils it down to 7 big pluses. Higher potential returns, inflation protection, maybe passive dividend income, owning pieces of companies you like.
Liquidity, diversification benefits for your overall finances, and that low starting cost we just talked about.
It's a strong case. But to be balanced, they also talk about the reasons not to invest, right? The potential downsides.
Absolutely essential to cover that. And the big one they flag is volatility.
Yeah, they don't sugarcoat it. Market drops are normal, expected even.
They give stats, don't they? A 10% dip roughly every year or so.
Yeah, 11 months on average, and a 20% drop every 4 years-ish.
And bigger ones, 30% or more, maybe once a decade. That can feel really scary when you're living through it.
No kidding.
Yeah.
So who shouldn't maybe jump in? What are the valid reasons to stay out, according to the source?
Well, several things. If you just cannot stomach seeing your investments drop significantly low risk tolerance, that's one. Or if you absolutely need that specific money in the short term, like within 3 to 5 years. For a house down payment, maybe?
Right. Not enough time to potentially recover from a dip.
Exactly. Also, if you're retired or close to it, and your main goal is just steady, fixed income, or, and this is a big one, if you have high interest debt, like credit cards.
Paying that off might be a better return.
Very likely, yeah. And definitely you need a solid emergency fund first before investing.
Makes sense. Safety net first.
And finally, if you just don't have the time or, frankly, the desire to do even basic research.
Those are all really practical points. It's about your personal situation.
Yeah.
But they also offer a counterpoint, don't they?
Yeah.
For people who do have time and can handle some risk.
Yes, definitely. For those folks with a longer time horizon, waiting on the sidelines can actually hurt your potential returns in the long run.
Because you miss out on potential growth.
Exactly. They argue that for good companies, the best time to buy shares is often, well, now, or at least not waiting indefinitely for the perfect moment.
Okay, so you weigh the pros and cons, you decide it makes sense for you. How do you actually do it? Where do you start? The 144 Technologies videos laid out a few paths.
Right, this is the practical bit, the how-to. They outline 3 main ways. First, you can go DIY, do it yourself, choosing your own stocks, your own funds.
Hands-on approach.
Yep. Second, use a robo-advisor, kind of automated expert management for a fee.
More hands-off.
Right. And third, often a great starting point is using your employer's 401k plan if you have one. Automatic contributions, long-term focus built in.
And whichever way you go, you need an account somewhere, yeah.
Spot on. An investment account is step 1. For DIY, that's usually a brokerage account. For robo-advisors, you open an account with them directly.
And the good news is, you don't need a fortune to open one.
Generally, no. Many brokers and robos have very low or even zero minimums these days.
Let's talk more about that DIY route, the brokerage account. What should you look for when picking one?
Okay, so opening an online brokerage account, often the fastest, cheapest way in. You can open retirement accounts there, like IRAs or just a regular taxable account.
And when you're comparing them.
Key things the videos mention: costs, commissions, any other fees. Investment selection, do they offer what you want? Commission-free ETFs are popular now. And research tools, how good are their resources if you want to dig into investments?
Got it. And the alternative for people who maybe don't want to pick stocks themselves, the robo-advisor.
Right, the passive option. They basically handle the whole investment management side for you.
How does that work?
You tell them your goals, your risk tolerance, how long you plan to invest, usually through a questionnaire. Then their algorithms build and manage a diversified portfolio for you.
And the cost.
Generally pretty low compared to a traditional human advisor, often around, say, 0.25% of your balance per year. And you can usually open IRAs with them, too.
Okay, choices there. Now, back to the DIY person for a sec. They open their account. Now they have to decide.
Yeah.
Individual stocks or funds. What's the difference, basically?
Big difference, yeah. Mutual funds, ETFs, exchange-traded funds, they let you buy tiny pieces of lots of different stocks all in one go.
Instant diversification.
Exactly. Spreads your risk right away. Index funds or ETFs are popular. They just try to match a market index, like the S&P 500. Really solid for long-term, like retirement saving.
Downside.
Well, you probably won't get those massive single-stock moonshots. It's more steady, broad market exposure. Oh, and a quick note, ETFs trade like stocks during the day, mutual funds price once at the end. Minor difference, but good to know.
Okay, so funds, diversification, maybe steadier ride. What about picking individual stocks?
That's buying shares in just one specific company, Apple, Amazon, whatever. The potential payoff could be higher, sure, but
Big but.
big but. The odds of getting rich off one stock, pretty low. And to get properly diversified just using individual stocks, you'd need a lot more money to buy enough different ones.
So for most people, especially starting out,
Funds are often the core. The videos lean that way, especially for retirement. But some people enjoy researching companies, owning a piece of something they believe in. If you do that, just do your homework. Know the business.
makes total sense. Spread the risk. Okay, budgeting. How much do you actually need to buy something?
Yeah.
How much should you put in?
Good questions. For individual stocks, the cost per share varies wildly, pennies to thousands. ETFs, though, often have lower share prices than the minimums on many mutual funds. Sometimes mutual funds want $1,000 or more to start.
So ETFs can be good for smaller budgets.
Can be, yeah. As for how much of your money to invest, if you're using funds, long-term goal like retirement, the example was maybe 80% in stock funds for a 30-year-old, the rest in bonds.
In individual stocks,
Keep that a smaller slice of the pie. Don't bet the farm on just a few companies.
right? Diversification again. And the big takeaway seems to be think long-term.
Absolutely. The videos really hammer this home. Forget fancy, complex strategies for most people. Stick to basics. Use diversified funds as your base.
Like that Warren Buffett advice they mentioned.
Yeah, the low-cost S&P 500 index fund suggestion. For individual stocks, if you buy them, think long-term potential. Believe in the company.
And maybe don't check your account balance 5 times a day.
Please don't, unless you're a day trader, which is a whole different ballgame. Those daily ups and downs, mostly noise for a long-term investor, just causes stress. Let it ride.
Good advice. So you set up your portfolio thinking long-term. How do you manage it over time? Is it set and forget?
Not quite forget, more like check in periodically. The idea is to revisit it maybe a few times a year. Just make sure it still matches your goals, your risk level.
Things changed, right?
Exactly. Like as you get closer to retirement, you might want to dial back the risk, shift some money from stocks to, say, bonds. Those are generally less volatile.
Okay. And keep diversifying.
Always. Not just different companies, but different types of companies, sectors, industries, and even different countries.
International investing.
Yeah, the videos mention a Vanguard suggestion. Maybe up to 40% of your stock allocation could be in international stocks. You can usually do that easily with an international stock fund. Adds another layer of diversification.
And is it possible for listeners outside the U.S.? Can they invest easily?
Generally, yes, but check the specific broker. They mention First Trade, TD Ameritrade, Schwab. Many big ones do accept international clients. Rules vary by country, though.
Okay. Something else they brought up. Knowing what kind of investor you are.
Super important self-assessment. When you open an account, they'll ask, what are your goals? How much risk are you comfortable with? How long are you investing for?
And active versus passive.
Right. Do you want to be hands-on, picking things, or prefer to set it and forget it more, maybe with funds or a robo? Most traditional brokers offer the whole range: stocks, bonds, ETFs, index funds, mutual funds to fit different styles.
And we keep coming back to diversification for managing risk.
Because it's fundamental. Don't put all your eggs in one basket. It's just financial common sense. Doing it with individual stocks costs more upfront, usually. Funds give you that diversification built in, which is great, especially when starting.
The last bit they touched on was different strategies, like value versus growth.
Right. Your investment strategy is basically your plan. How are you going to reach your goals? It depends on those goals, your risk tolerance, when you need the money.
Conservative or aggressive?
Could be anywhere on that spectrum. Protecting wealth is conservative. Aiming for super fast growth is aggressive. And it's not set in stone. You should review your strategy as life changes.
And risk.
Always there. Basic rule. Only risk what you could, theoretically, afford to lose. Higher risk often means potential for higher returns, but also higher potential losses. Want safety probably means lower returns.
And value versus growth, briefly.
Value investing is like bargain hunting. Looking for stocks that seem cheap, undervalued by the market compared to their true worth. Growth investing is focusing on companies expected to grow their earnings really fast, faster than average, potential for big price increases if they deliver. Different philosophies.
Got it. So wrapping this all up, it really sounds like getting involved in the stock market, it can be a really effective tool for building wealth, protecting it long term.
Definitely. And the key takeaway is that it's more accessible than people think. Lots of ways in, depending on what suits you, how much risk you're okay with.
Yeah, that accessibility point is huge now.
It really is. Understanding these basics, having that long-term view that's crucial for navigating it well.
And yeah, we covered a lot, but there's always more, isn't there? Like fundamental versus technical analysis, digging deeper into strategies,
Yeah,
maybe for another time.
always more to learn. Which kind of leads to a final thought for you, listening in. Yeah. Just consider, what's one small, informed step you could maybe take, even today, to start making your money work for your future? Now that you've got a handle on these core ideas, how does that empower you? How does it change how you look at investing?